I think one of the things we're certainly agreed on is that we would avoid Japan. All the evidence again there is that politically, economically, and certainly from the perspective of the currency, Japanese yields are likely to rise quite significantly, and that's certainly not in the market pricing at all. Another area we don't like is China and anything associated with it. It has historically been quite easy for us to avoid. It's a growing part of the index. Not only is it quite difficult to trade to understand, but yields are also at record lows in China. So purely from a valuation perspective, it's got a void written all over it. And then the third thing, which again I mentioned previously about this idea of the unwind of the Trump trade, we still prefer shorter dated maturities to longer dated ones. Investors just haven't been compensated enough for that longer dated risk. So no Japan unless yields move significantly higher, and no China pretty much in perpetuity as far as we can see at the moment, and the preference for short holding long dated bonds.
Yeah, within credit, indiscriminate buying across the credit asset class this year meant that there's really little differentiation between cyclicals and non-cyclicals in valuation. So we'd rather be more defensive and avoid those cyclical areas. Also, we have been avoiding the auto sector. That's a classic Trump trade, however. So after spreads blew out on the auto sector, we have added one named Benteler, which actually benefits from the Trump trade because of this steel exposure. However, we still really think that the auto sector still has more room to underperform, so we'd rather avoid that sector overall.